Here's a brutal truth that the trading industry doesn't want you to know. Approximately 90% of retail traders lose money. Not break even, not make a little, they lose. And after a decade of trading and coaching thousands of traders, I can tell you exactly why this happens, and more importantly, how that remaining 10% consistently pulls money out of the markets while everyone else burns through their accounts. Introduction. If you've been trading for any length of time, you've probably felt it, that sinking feeling when another trade goes against you, the confusion when a strategy that worked last month suddenly stops working, the frustration of watching your account slowly bleed out despite doing everything the YouTube gurus told you to do. But here's what nobody tells you. The reason you're struggling has almost nothing to do with your technical analysis skills, your understanding of candlestick patterns, or which indicators you're using. The real reasons traders fail are far more insidious, and they're baked into the very way most people approach this game from day one. Today, I'm going to walk you through the 5 core reasons most traders never make it, and more importantly, what the profitable minority does differently. This isn't going to be comfortable, but if you're serious about actually making money in the markets, you need to hear this. Reason number 1, the fundamental misunderstanding of what trading actually is. Let's start with the biggest problem. Most traders don't understand what they've actually signed up for. When someone decides to become a trader, they think they're learning a skill, like playing guitar or speaking a language. Learn the patterns, understand the indicators, practice for a while, and boom, you're profitable, right? Wrong. Trading isn't just a skill, it's running a business where your product is capital deployment, your customers are unpredictable, and your profit margins are razor thin. But most traders approach it like it's a video game or a puzzle to be solved. Think about any successful business. They have a business plan. They have operating procedures. They track metrics obsessively. They have risk management protocols. They know their strategy's expectancy, win rate, average win and average loss. They track every single trade in a journal. They review their performance weekly and monthly. They have protocols for different market conditions. If you walked into a trading floor at a proprietary firm or a hedge fund, you'd see this business-like approach everywhere. But retail traders, they're winging it and wondering why they're not profitable. Reason number 2, the lack of a true edge. Here's a question that should make you uncomfortable. What is your actual edge in the market? And no, I use the RSI and moving averages is not an edge. I trade support and resistance is not an edge. These are tools. An edge is a repeatable advantage that allows you to extract money from the market over a statistically significant number of trades. Most traders never develop a real edge because they never do the work required to find one. They jump from strategy to strategy, indicator to indicator, always looking for the holy grail setup that works every time. But that's not how edges work in trading. Let me give you an example of what a real edge looks like. A profitable trader I know specializes in trading the first hour after major economic news releases. He spent years studying how different assets react to different types of news under different market conditions. He knows that when certain conditions align, there's a 60% probability that price will move in a specific direction. And when it does, the average winner is twice the size of the average loser. That's an edge. It's specific, it's tested, and it's repeatable. But finding an edge requires work that most traders aren't willing to do. You need to study thousands of chart examples. You need to backtest rigorously. You need to forward test in real market conditions. You need to track what works and what doesn't with obsessive detail. The uncomfortable truth is that most traders never develop an edge because they're not willing to put in the time. They want profitability now, not after 6 months of research and testing. So they keep trading strategies they don't truly understand, wondering why the market keeps taking their money. And here's the really hard truth. In today's markets, where you're competing against algorithms, AI, and institutional traders with billions in resources, having a mediocre edge isn't enough. You need a genuine, tested statistical advantage, or you're just gambling with extra steps. Reason number 3, the psychology gap. This is where most traders actually lose the game, even if they have a decent strategy. You can have the best trading strategy in the world, but if you can't execute it consistently when real money is on the line, it's worthless. And this is where 90% of traders implode. Here's what happens. A trader develops or learns a strategy. They backtest it, maybe even demo trade it. It looks good on paper. Then they go live with real money and everything falls apart. They take profits too early, they hold losers too long, they skip trades that meet their criteria because they're scared. They take trades that don't meet their criteria because they're bored or trying to make back losses. Why does this happen? Because trading exposes every psychological weakness you have. Your relationship with money, your need for certainty, your fear of being wrong, your inability to follow rules, your need for excitement. All of it gets dragged into the light and weaponized against you. Let me paint a picture you've probably lived. You take a trade based on your setup. It goes against you. Now you're down a few $100s. Your heart rate increases. You start rationalizing. Maybe I should close it early. Maybe this time is different. Maybe I should move my stop loss just a little. Or the opposite. A trade goes in your favor quickly. You're up $500. Your brain starts screaming at you to take the money and run. What if it reverses? Better to have a small win than watch it turn into a loss. So you exit, watching in frustration as the trade continues another $1,500 in your direction. These aren't technical failures. These are psychological failures, and they compound. Each time you deviate from your plan, you reinforce the neural pathways that make it easier to deviate next time. You're literally training yourself to be a worse trader. The profitable 10%, they've done the psychological work. They understand that trading is about process, not outcomes. They can take a loss without it affecting their emotional state. They can follow their plan even when every fiber of their being is screaming at them to do something else. They've learned to detach their ego from their trades. How did they get there? Usually through years of pain, often working with trading psychologists, and always through brutal self-honesty about their psychological triggers and weaknesses.
Reason number 4, catastrophically bad risk management. If psychology is where most traders lose the game, risk management is where they lose their entire account. Ask a losing trader about risk management and they'll tell you they risk 1% or 2% per trade. They think this means they're managing risk, but position sizing is just one tiny piece of the risk management puzzle, and most traders are still exposing themselves to catastrophic risk without even realizing it. Here's what proper risk management actually looks like, and why most traders fail at it. First, there's position sizing, which most traders do wrong even when they think they're doing it right. They risk 1% per trade, but they don't account for slippage, don't consider the correlation between their open positions, and don't adjust their risk based on their strategy's recent performance or changing market volatility. Second, there's portfolio heat, the total amount of risk you have on at any given time across all your positions. I've seen traders who risk 1% per trade but have 10 positions open at once, meaning they have 10% of their account at risk simultaneously. One bad day or one market shock and they're down 10% or more. That's not risk management, that's Russian roulette. Third, there's drawdown management. Most traders have no plan for what to do when they hit a losing streak. They keep trading the same size, digging themselves deeper and deeper into a hole. The math of drawdowns is brutal. If you lose 50% of your account, you need 100% return just to get back to break even. But traders keep making the same bets even as their account shrinks. Fourth, there's tail risk, the black swan events that wipe out accounts. Most traders are completely unprepared for these. They're trading with tight stops but no consideration for gap risk. They're holding positions over major news events. They're trading illiquid instruments where a single bad fill can devastate their account. The profitable traders? They're paranoid about risk. They're constantly asking themselves, what could go wrong? They have rules for maximum portfolio heat. They scale back position sizes during losing streaks. They have worst-case scenario plans. They understand that preserving capital is more important than making money, because you can't make money if you've blown up your account. Here's a framework that profitable traders use but losing traders ignore. They assume that anything that can go wrong will go wrong eventually. Flash crashes will happen, brokers will fail, they'll fat finger trades, news will hit mid-trade, and they build their risk management systems to survive all of it. Reason number 5, the lack of patience and realistic expectations. Finally, we come to the reason that destroys traders before they even have a chance to succeed. They want it too fast. Someone starts trading with $5,000 account and wants to turn it into $50,000 in 6 months. That's a 900% return. To put that in perspective, the greatest investors in history average 20 to 30% annually. But retail traders think they're going to 10x their account in half a year while working a full-time job and learning as they go. This unrealistic expectation leads to over-leveraging, over-trading, and taking stupid risks. It leads to jumping from strategy to strategy when something doesn't work immediately. It leads to revenge trading after losses to make it back fast. The truth about trading is this: it takes most successful traders between 2 to 5 years to become consistently profitable. Not 2 to 5 months, years of studying, testing, losing money, adjusting, learning, and slowly building competence. And even once you're profitable, the returns aren't usually what people imagine. A skilled trader might make 20 to 50% annually with reasonable risk. That's exceptional in the investment world. But if you're starting with $5,000, that's $1,000 to $2,500 per year. Not exactly quit your job money. The traders who make it are the ones who embrace this reality. They focus on the process of becoming a better trader, not on the money. They celebrate when they follow their plan, regardless whether the trade won or lost. They understand that competence comes first, and money is just a byproduct of competence. They're willing to spend a year just mastering one setup. They're willing to demo trade until their strategy is proven. They're willing to start with small size and scale up slowly as they prove consistency. They're playing the long game in a world where everyone else wants instant gratification.
The path forward. So what do you do with all this information? First, get brutally honest with yourself. Which of these 5 reasons is killing your trading? For most of you, it's probably multiple. That's okay. Awareness is the first step. Second, start treating trading like a business. Write a trading plan, define your edge, test it rigorously, track every trade, review your performance regularly. If you can't explain exactly why you have an edge in the markets, you don't have one, and you shouldn't be risking real money yet. Third, do the psychological work. This might mean working with a trading psychologist. It definitely means keeping a detailed journal that tracks not just your trades, but your emotional state, your triggers, your deviations from your plan. You need to understand your psychological profile as a trader. Fourth, get religious about risk management. Calculate your maximum portfolio heat. Have rules for scaling back during drawdowns. Never, ever risk money you can't afford to lose. Remember, your first job is to not blow up. Your second job is to make money. Fifth, embrace the long game. Stop trying to get rich quick. Focus on becoming competent and trust that profitability will follow. Give yourself permission to spend a year or two just learning without the pressure of making life-changing money. Look, I'm not going to sugarcoat this. Most of you watching this video won't make it as traders. That's just the statistical reality. But some of you will. The ones who will are the ones who can look at these 5 reasons unflinchingly and commit to doing the work required to overcome them. Trading is one of the most difficult ways to make easy money. It requires skill, psychology, discipline, capital, and time. But for those who are willing to treat it with the respect it deserves, it can be incredibly rewarding, both financially and intellectually. The question is, are you willing to do what the profitable 10% does, even when it's boring, even when it's hard, even when it takes longer than you want? If you found this valuable, hit that like button and subscribe. I share real trading insights without the hype or the nonsense. And drop a comment below telling me which of these 5 reasons resonates most with your experience. I read every comment and often create follow-up content based on what you tell me. Until next time, trade safe and trade smart.